Hey everyone, and thanks for jumping back into the macroverse. Today, we're going to talk about United States job quits, and we're going to look at correlations with the S&P 500. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. We do have several different tiers available. Make sure you check it out. Links in the description below. Let's go ahead and jump in. So we're going to keep this video somewhat brief. I do occasionally like to go over some more macro indicators with you guys just so we can see what's going on within the macroverse. Of course, things can move at a snail's pace, but in this video, I want to talk briefly about US job quits. Now, if you're not familiar with what this means, a job quit is defined as an employee who's leaving their job voluntarily. Okay, so it doesn't mean people getting laid off or fired or anything like that. It just means someone that's, they raise their hand and they say, hey, I'm leaving this job. And it could be for whatever reason. Maybe they found a better job. Maybe they just don't want to work. Maybe they saved up a lot of money. Maybe they made a lot of money in the market and they've just decided, you know what, I don't really want to work for a while. And so you would expect that if we think about this, from like a sort of just like try to think about it from a rational point of view, if the economy is quite healthy and people in general are doing well, you're more likely going to see people voluntarily leaving their jobs. Maybe they have enough money in the bank, and they're just not worried about it, or maybe they're just hopping around between jobs because the economy is strong and can support a lot of movement there. Maybe a lot of companies are hiring, whatever it might be. The point is that when the economy is strong, you'll tend to see people leave their jobs voluntarily more frequently than when the economy is not doing well. Okay, so that's the important thing. You'll notice we have some gray shaded regions on the chart. Those correspond to recessions. Now, in a recession, you will see that job quits tends to go down. Again, why does it go down during a recession? Well, in a recession, when we're under harder economic times, there's going to be fewer people that are going to be willing to just voluntarily leave their job because, again, they might not find a job anywhere else. Perhaps they don't have as much money in the bank, and it's just not a luxury that they can afford to do to just voluntarily quit their job. So during a recession, there are fewer people that voluntarily quit their job, right? And so you can see that this metric goes down a lot. Now, again, this is in thousands of jobs, so do keep that in mind when you're sort of looking at the y-axis over here. But look how quickly this went down. Now, the blue line here is the S&P 500. So again, the orange sort of shaded box, or sorry, not the box, the orange shaded region is US job quits, but the blue line here is the S&P 500. And you'll see that US job quits sort of peaked out over here in 2006, 2007, and started to show a little bit of weakness. And then it accelerated to the downside, and during that, you can see that the S&P 500 itself accelerated to the downside and saw a fairly sharp sell-off. Now, what's interesting is while you can see over here the U.S. job quits started to go down really before the S&P 500, you'll notice that over here, the S&P 500 started to go up before U.S. job quits had bottomed. Okay, you can see that over here. After the dot-com crash, you can see it over here in the financial crisis. The S&P 500 bottomed in March 2009. U.S. job quits bottomed in August of 2009, so almost half a year later. But then you can see that, the market was back to business as usual, trending higher, and so U.S. job quits started to trend higher as well as people became more comfortable quitting their job. The economy was stronger. They probably thought, if they're going to quit their job, they can probably go find a new one, or again, maybe they just didn't need to work, whatever it might be. You can also see over here during the crisis we had back in 2020, the S&P 500 bottomed on sort of late March or so, and then U.S. job quits didn't until April. So again, another example of the S&P 500 bottoming out before U.S. job quits bottomed out. But also, you'll notice here that job quits started to go down before the S&P 500 started to go down. So it's interesting because we don't really have a whole lot of data, right? But you'll see that in both of these cases, U.S. job quits started to really roll over before the S&P 500 did, but the S&P 500 bottomed before U.S. job quits did. Okay, so kind of interesting thing to look at. So now, of course, we'll get to sort of the more pressing question is what's happening over here? Well, we've had a very resilient labor market. I mean, again, this is one of the strongest labor markets that I think we've seen, at least for the last 40 years or so. In this case, you'll see that U.S. job quits sort of topped out here in November, but it also came up to that same level again in April. So if you count it from here, you can say that it led the stock market. But if you count it from here, then you can't really. Just one more double top, right? It just seems like they pop up everywhere these days. Um, but one of the things that I thought was sort of interesting to look at is actually coming down somewhat quickly here. I mean, you can see the sharp decline from December to January was pretty significant. I mean, this is a pretty significant drop. Now, again, we're looking at this and it's almost the end of March. But again, there's always sort of lags with some of this data. So we'll see, we'll see where it continues to come in. But I would say if this continues to go down quickly, then it would be somewhat of a warning sign, for things like the S&P 500. If it levels out, then perhaps it would. But considering all the layoffs we're seeing throughout especially the tech world within the technology industry, and we're starting to see it hit some other places as well. We've seen Meta recently close a lot of open positions in addition to laying off thousands of people, and it's making it, I think, more and more difficult for people to to find jobs. Now, again, we still are in a fairly resilient market, at least so far. But as long as the Fed keeps tightening, it's hard not to imagine that it won't loosen up at some point, right? It seems like the labor market will loosen up at some point. Again, people voluntarily quitting their job, the number of people voluntarily quitting their job is going down. And it could be just because people are not as convinced they're going to be able to find a job, or maybe they're worried about economic hardships coming up. But I thought this was interesting to look at. And of course, as always, we'll go look at the monthly change, because that's always something that I think that we need to look at as well. If you look at a percentage, you can see this has come down quite a bit in a relatively short period of time. But as always, why don't we apply moving average to it? And here you can see that it really started to accelerate back in middle of 2022, but then it kind of leveled off for a little bit. Didn't really make a huge move in either direction. But I think we need to keep an eye on it now, just because of how quickly we saw it sort of come back to the downside, back in the last couple of months or so. So you can see that these recessions tend to correspond with a lot of sort of area under the curve, right, when it's below zero. Maybe we'll switch this over to a 7-month moving average, and you can see this a little bit better. So look at the 7-month moving average of U.S. job quits, the percentage change, the monthly change. So again, when it's just spending a lot of time below zero, market's not doing well, like it did during the dot-com crash, like it was during the financial crisis. You can see it was very brief over here. Market went down a little bit, but of course we did not have a recession then. Over here, not a whole lot to speak of, just very brief moves to the downside. Of course, what we had in 2020 was a pretty sharp move. And again, here we're still spending, we're averaging a lot of time below zero, meaning we're seeing a decline in people voluntarily leaving their jobs, which, if history is any indication, is not the best sign. And it does show there's at least some weakening in the U.S. economy if people are not as willing to sort of voluntarily leave their jobs as they were at one point. Again, it's an interesting indicator to think about, but I think when you think about it a lot, it makes a lot of sense, right? People are just not going to leave their jobs as willingly or as voluntarily, right? If they're worried about the economy and their ability to, say, pay their bills in the future. Whereas if the economy is doing really well, then those people aren't going to have those same concerns, and they might be a little bit more willing to voluntarily leave a job because they have the money in the bank as a safety net, or they feel like they can find another job. So hopefully you guys enjoyed this video. Make sure you leave a comment down below if you like the macro stuff, you want to see more of it. But again, also thanks for tuning in. Make sure you subscribe, give the video a thumbs up, and I'll see you guys next time. Bye.